guys, welcome back to ASMR Money Mentor. So I have to say this is a little eerie for me because you are watching this on Friday, which will be a day after or 2 days after the Hurricane Milton that may have come through my part of the west coast of Florida. And if it lands north of me, then as you know, this condo most likely would be underwater, potentially halfway up the walls, maybe even higher. The storm surge, they're saying, could be 11 feet. And as you know, with Hurricane Elaine, it came up to my patio, and that was like a 7 or 8 foot storm surge. So, I don't know. It's a little eerie because when I edit this episode, I will have already known what happened. And so I'm sure I will talk to you about what happened if I have not done so already. But today I want to talk about how cash affects retirement. So thank you again to the subscriber that wrote into the show at evanthomasbroke@yahoo.com, which you guys can do as well. Send me a question, let me know what your question is, and I will probably create episodes based on your question. And for those of you that have written in about a case study, I'm still working on those, so please be patient. This past month and a half has been really stressful with the hurricanes. I feel very vulnerable. I haven't had a lot of time to be thinking about producing these episodes with my normal job, with the hurricane risk, with evacuating. I've done so much back and forth. It's a lot of work. You have to pack your bag. You have to pack everything you need for work. You have to go either get a hotel or go somewhere. So with these hurricanes being back to back, I have not put or had the time to think about episodes too much in terms of the case studies, but I will circle back to it, I promise. And I will share some of the success stories of what you have told me by writing into the show. But if you have a simple question, write in again to evanthomasbroke@yahoo.com, and I'll probably create an episode about your question. So moving on to episode 107, I did want to talk about, again, piggybacking off of the previous 2 episodes this week about having cash on hand for emergencies, for job loss. But you know, someday you guys will get to a point like where I am, where I'm going to be retiring at the end of the year. Unless, of course, I chicken out if my place floods. I kind of told my boss as a joke that if my place floods, I may want to work a little while longer. So let's see what happens. Anyway, I will say that as you get closer to retirement, most money coaches, most financial advisors will probably encourage you to have more cash on hand. When you're younger, you need it for what I just mentioned. When you're older and you go into retirement, one philosophy of retirement is that because markets, as you know, go up and down, you may want to have cash on the side to weather the storms. No pun intended with Hurricane Milton coming. To weather the storms of down markets. So if the stock markets go down, I feel like I'm in a stock market right now with all of these surges in my emotions and surges in the weather, which is affecting me because of the choice that I made years ago to buy this condo. Anyway, it all goes together. But if you have cash on hand and the market goes down, let's say for a year, you may not want to sell the shares because they're priced really low. You don't want to sell shares when they're priced low. You want to sell shares when they're priced high, which is why money coaches usually advise you as you're moving along to rebalance your portfolio. That's all it means. Just sell some of the shares. You know, you click a button within your 401k, rebalance. let's say you might get to 70-30 and you're like, wait, I have to sell 10% of the stocks, put it back into the bonds in order to reduce the risk if the market goes down, because suddenly you're more balanced. The more balanced you are into income producing assets like bonds and cash, the better for not losing money. Okay? So as you get close to retirement, one philosophy, and the philosophy that I chose, was to build cash reserves. So you may remember me talking about the fact that over the past 2 years now, maybe even 3 years, 22, 23, 24, whereas before I was maxing out my 401k to the total dollar amount that you can contribute, which was like 25, 30,000, whatever it was, I reduced that to just get the match with the company, and I was hoarding the money in my cash in my account, my checking account, rather than putting it into my 401k. Then I would, at the end of the month, move that money into these money markets and things I've been talking about this week, because they were paying relatively high rates. Then I would capture some of that into the CDs. Remember the 50,000 CD, which is an 18-month, the 30,000 CD, which is I think a 3-year. I may have gotten that backwards. But you make decisions as you get closer to retirement with cash. And what that is going to allow me to do, as I've shared with you before, and let's see if I can do it off the top of my head. At the end of the year, I'll have $150,000 in cash, meaning short-term reserves, CDs, money markets, online savings accounts, iBond. I consider that iBond cash. That's going to be $150,000. Now remember, in retirement, I may need, remember I'm going to have that credit card to put down for food and gas and fun. I'm going to take that 0% credit card and keep it there. Keep the money in my online savings account at 4% where it is right now. It may go down to 3 or 2, but right now it's 4%. Then pay that off, which is allowing me to have less cash in my checking account in the first year. But overall, let's say it's on average 30,000, 30,000, 30,000. Well, that's 90,000, right? Now, in the first 5 years, my income will be my short-term reserves. It's not income. I'm calling it income because it's used to pay for my life. So if we say we've got 150 plus, I'll have 40,000 in Social Security at age 62 and 63. So 59, 60, 61, 62, 63, that's 5 years. So the bucket is 190 of money. Then you reduce every year. What do I need? 30, 30, 30, that's 90. What's 190 minus the 90? That's 100. 2 more years. So I could have about, I think, 80,000. I figured out 60 to 80,000 at the end of that 5 years still, before I even get to withdrawing money from the nest egg that I created in my Fabulous 4, which is my Roth, my 401k, my taxable account, and my health savings account. Remember, that money is going to grow for 5 years from 1.3, let's say, 1.3 million to potentially 1.6 million, depending on how well the market does in those 5 years. In a 5-year time horizon, even if there's a dip in the middle or anywhere in there, you're usually leveling out to about, 3 or 4% on average. The more you go into 10 years or 20, the greater the overall return, I guess. The shorter the term, there could be more volatility. Anyway, that is how I am using cash in retirement. That was my choice, to create these buckets of cash reserves, because I kind of feel like there might be some risk coming in the next 5 years of downward markets. We've had such a good bull run of the stock market since I started investing back in 2004 and 2005, even with the recession, and then I just rode that right back up. You may recall me saying that there were some flat years. 2018, I lost a little bit of money. 2022, I lost about, 15%. Yeah, say that, my 1.3 million in my investments right now, you guys know my net worth right now is 1.6, because that includes 1.3 and then about 100,000 or a little bit more, that 150,000 in cash reserves, and then my condo value on top of that brings me to 1.6. But if I lose the condo and I have to live somewhere else, I've kind of built myself buffers in that I could probably do that. Not that I would want to, but instead of having the 1.3 in that 5 years, now it's 1.1 if I have to go buy another condo and then wait for this one to get the insurance. Are you following me? So it's kind of like, as you get closer to retirement, you need to build in these buffers if you are taking certain risks, and all of us take risk. We're taking risk driving to work. We're taking risks with everything we do, and we're willing to accept those risks. Now there may be a time where you're kind of fed up and you don't want to take that risk anymore, and that might be where I'm at in the next year or so, or maybe now, if the result of Milton was not to my advantage. So anyway, I'm going to leave you with that. I hope you enjoyed this episode number 107, and if you did, give me a thumbs up. I appreciate you guys being here. I believe in you, and I congratulate you for every step of the way. I hope you consider subscribing if you have not subscribed.